I want to talk a little bit about some of the presentations we've seen before. I think Eric made some good points about this market, and that as much as it's risen, and I'm going to show you some charts to this effect, as much as it's risen so far that we're kind of locked into this. We're in the forest, can't see the trees, or vice versa, however that goes. There's an old saying that a market is hated the most by those who know it best. And we've been beaten down over the last 4.5 years by this market. Every little rally, and it's just beat us about the head and then gone right back down. And so we're the ones that have been most skeptical about this. Whereas the people, the generalists, the newbies to the sector, they're looking at it, they're looking at the charts, and they're saying, wow, this really looks like a breakout. Look at the long-term trend. This is the real deal. And we were kind of holding back, saying we don't want to get burned again. So there's a lot of money that's coming into this market. Unfortunately, a lot of these people are making more money than we are, despite all of our tuition that we've paid, because they don't have the losses that have mounted over the past few years. So I'm going to go into that a little bit, but a little bit of an anecdote. I just got back from, or just left from talking at the Money Show Las Vegas show. And this, for those of you that don't know, that's a group that has a very much of a generalist investment conferences all across the country, retail individual investors, free shows, but it's not gold oriented. And I'm just stuck, I guess, in our echo chamber here, but I really didn't realize that there were that many people out there who are retail investors who went to conferences who really didn't invest in gold. And I'm giving my presentations, and I have to introduce myself as the crazy gold bug on the agenda. And number one, it's good to be in familiar surroundings of a friendly crowd and fellow gold bugs. But they just looked at me with blank stares. At one point, there was a room of about 1,000 people, and said, how many people here are invested in gold? And maybe 15% of the crowd. And the questions we were getting were, how do we invest in gold? How do we invest in gold? Well, first you subscribe to my newsletter, and but I had to lay the whole thing down from the foundational and the whole story. The last panel, well, that's all to say that there's just a small fraction of the potential funds out there that can come into this market. If only 10 or 15% of those people in that room who were active investors are involved and are very involved, we really have a lot of money that can come into this market as things get a bit more exciting. And these people are looking at the long-term charts and thinking they're in early. And we're looking at the charts, and we're looking at gold up 20, 25%, the indices, mining indices doubled. We think that a lot of it's gone, but there's a lot of people out there who think very differently. One other quick point, the last panel I had at that Money Show, it was Wednesday, about 1:45 Pacific time in the afternoon, and I recommended Kamenak, and I told them this is on a short fuse. So they didn't have a chance to buy it, but boy, I looked smart. And really, what matters, huh? So let me get started here. Crossroads for gold. I really think we are at a crossroads for gold. I'm going to go through some charts. I'm not a technical analyst, but I do play one at conferences. I've just been in this market enough where I've seen a few things that are curious. To sum up the situation, the long bear market has ended. We've had enough confirmation of that. Mining stocks are multiplying in price, but the market structure in gold has shifted in some important ways. In some of these ways, very recently. Biggest gains lie ahead over the long term. There is a near-term negative potential bearish factor. The commercial shorts are really mounting to historically excessive levels. This has, in recent history, has always preceded a significant setback, but there's a potential that it could actually provide fuel for a bigger run. Here you have a chart of long-term gold. Now what I want to focus on here is, again, I'm not a technical analyst, but a friend of mine, Ron Grease, who owns thechartstore.com, great service, has a weekly chart blog that's worth its weight in gold. I highly recommend it. One of the things he's done is taken this typical stochastic momentum indicator. I usually use a 14-week indicator to get an idea of where the market's going in the near term. This is a very long-term momentum indicator. And what's interesting about this is this pattern right here of a bottom, long bottom, and then an uptick. If you look here, when we've had similar situations, this was the 93, 96 bull market. This was the big bull market that started in 2000. Very similar patterns. Here we have it again. Now, just for giggles, I've done the same thing on the long-term dollar index, and it works here too. Here you have an identical pattern, similar pattern, each pertaining to a peak in the dollar index. Here again. I don't really believe that I know there's not always a real close correlation between gold and the dollar index, but that is an interesting thing that I thought was important to point out. Gold and silver, by the way, that pattern is also present in silver. Gold and silver have moved. And companies, junior companies with large established resources have moved and really risen in price. I think now we're going to have to start looking for other metals and a little further down the food chain toward the more earlier stage development companies, Explorcos and the like. But here we see in copper a similar situation, similar pattern on that long-term stochastic. If anything, this is a bit more dramatic. It doesn't really point toward an immediate rise in copper, but we have seen some strength in copper. I think copper is something we need to just look at as perhaps the next sector or metal to move. Again, this is really not relevant to our talk, but I thought it was interesting. We have the same kind of a situation in oil, so we may have a rebirth in that. And that would talk toward more of a general uptrend in commodities that would reflect what's going on in the world of negative interest rates and the like. So it could be a very good thing for gold and commodities in general. Now, if we look at the shorter term, 14-week stochastic, what I want to point out here is you see these sharp peaks where the market would have these false rallies. It would go up and go right back down. The momentum would shift. We, as gold investors, resource investors, would just get it handed to us over the last, really since the peak in 2011. Very sharp returns in the momentum. If you look back during the heyday, 2004, 2005, 2006, and 2007, those peaks in that stochastic were broader. They lasted a bit longer. They were more extended, rounded. This is kind of a key area. This is why I say we're in a crossroads here. We've already established right here that it's not quite as sharp as we've had during this bear market. It's starting to extend a bit. That's very important, I think, and indicative of where we are and where we might go. Same thing in silver. It tried to come back down in another sharp return, and then it went right back up. So silver is confirming the gold bull market, has confirmed the gold bull market. That was one of the things that we were all questioning as gold took off, is when is silver going to take off? Because in a classic gold bull market, silver outperforms gold. That's happening right now. So that's another confirmation that we've seen. Copper is the same type of a pattern that we're seeing. That top in stochastic is starting to round off. Gold and Bollinger Bands. This is something we look at. Typically what happens when these Bollinger Bands compress or squeeze, that portends some kind of a breakout, usually in the direction that was holding forth beforehand. Silver, the same thing, except we have a potential head and shoulders pattern here. That pattern, from a technical standpoint, would project to silver price of $18.65. These are all positive confirmations of where we are in this market, that this has changed. The dollar index, what I'd like to point out here, and again, a weaker dollar is bullish for gold. A strong dollar is not necessarily a negative for gold. But when you look at people talking about a dollar index, it goes back to highs in previous years. I don't think it's going to happen. This red line marks 100, right about 100 on the dollar index. The last time it hit that, it reversed. Mario Draghi went in front of a microphone. He talked up the euro, and the dollar turned back from that, dollar index turned back from that $100 level. I said, well, isn't that curious? I went back to the previous time in March of 2015 and looked at when it hit 100 again. Sure enough, Mario Draghi went out at that point, got in front of a microphone, and talked the dollar down. I think these people talk to each other. And I think they have an upside on the dollar. So don't be afraid of that. Gold-silver ratio, falling gold-silver ratio is an indication of a bull market environment. It's not something you can really pin down very closely at certain levels, but when the gold-silver ratio is above 80 and then starts to fall, that's generally, it is an indication that silver's outperforming gold. Again, a classic bull market environment, silver is outperforming gold. You can see all of these instances where the gold-silver ratio fell corresponded with very strong rises in the gold price. Here again, we have what seems to have been a topping action in the gold-silver ratio, another confirmatory factor. As far as upside potential, this is an interesting chart that Ron drew up. Typically, we do a lot of things where we show the price deflated by the CPI to get a real inflation-adjusted price of a commodity. In this case, what Ron did was he deflated gold by the monetary base. And what you see, gold in nominal terms is in this red-orange mark. So you see the big rise in the 70s, see a big rise from 2000 on, and then this bear market here. You see a tremendous rise in monetary basis here in the 70s, here, of course, in the 2000s, and here again in more recently after the 2008 credit crisis. What this chart essentially shows is that as much as we've seen in gold, as much as we saw gold rise since 2000, it didn't keep up with the rise in the monetary base, US dollar monetary base. So it has a lot of potential left built into the structure of the Federal Reserve balance sheet, the monetary base of the United States. Gold has underperformed that rise in money. So number one, it says that maybe there were some hijinks involved, but what it really says, in my opinion, is that there's an awful lot of money out there and gold has underperformed the rise in that money. So there's a lot of room to make up. Okay, so here we see what's happened in the gold miners, the Junior Gold Miners Index, a tremendous run. Again, this is what we see. If you look at a longer-term chart, which I don't have here, but if you look at a longer-term chart, the generalists in the market are looking at that and saying this is just the start. I want to show you a potential negative factor coming up. Again, the large commercial short position. The large commercials, the category of paper gold traders on the COMEX and the CME, are categorized as typically miners, producers, people involved in the jewelry trade. They've come to include a number of bullion banks that facilitate gold loans, financings, et cetera, for the trade. And these big bullion banks also have the proprietary trading desks. So over time, over the last 5 or 6 years, this is about a 1.5-year chart. But over time, what we've seen them do is they'll build up their short positions as the market rises, and then they'll just flood the market with shorts, crater the market, it'll go down, they'll make money in their short positions, then they'll start reloading at the bottom. This is an inverted chart showing the short positions. As it goes down, the aggregate number of short positions increase. You can see that every peak or trough in the short positions is associated with a peak in the gold price, an interim peak. So pretty significant. Look where we are now. Last week, and I didn't see what the COT report was yesterday. Actually, I was traveling. But last week, they loaded another 55,000 shorts on top of a 242,000 aggregate short position. So they're really getting to some extremes here and really trying to crater this gold market. Frankly, I feel we have about a 70% chance that we're going to have a near-term correction sometime over the next, I guess, 6 to 8 weeks, if this keeps up, 4 to 8 weeks, something like that. Odds favorite, I think that correction would probably, you would look at it to give up about half of the gains that we've enjoyed so far. So really, we'd probably lose in that scenario about $100 to $125 on the gold price. If that happens, I think it's a really a buying opportunity. Remember what you're thinking right now. Gosh, if only I could get the prices of a few weeks ago for some of these companies. That may actually happen again. If it happens, then you need to jump on it. The caveat here is that sometimes the market gets away from these shorts, from these commercials. They can't short it, and then they have to cover their shorts, which then puts more fuel under the market, accelerates the gains, and they never catch up to the market. That happened in the 2004 to 2007 time frame, and that's when some of the biggest gains in this market happened. So there is a good chance that they're going to get their shorts handed to them. And this could be actually the fuel to take the market up to another level. We really don't know. We just got to wait to see if it happens. Seasonality, looking at my summary here, seasonality is another potential negative. We're going into the summer season. However, I'm going to show you one reason why seasonality may not be much of a factor this year. Seasonality in gold is based on physical demand by Asia primarily. You run out of festivals in summer, early summer, so the physical demand tends to go down, the price tends to weaken. However, what we've seen is that a lot of the demand, and I'll show this in a second, a lot of demand in this market has come from Western investors, not so much from Asian investors. Now here I'm going to go over very quickly the great gold giveaway, the flow of gold and wealth from west to east. This has happened primarily since the 2013 crash in the gold price that spring, where Asians, just primarily China, have come into the market and really tried to buy up all that they could get on discount. But this run, since January, as you can see, has been largely driven by flows into the ETFs, which I use as a proxy for Western gold demand. This is all of the gold ETFs, all the bullion depositories in one chart. This comes from sharelinks.com, which is a great service. And you can see what's happened so far this year. This has been driven, rather than withdrawals like we've seen, we've had a massive inflow into these ETFs. That's driven this bull market. Over the last few years, Asians have supported the market, if not been able to drive it higher against the paper gold sellers. This is East versus West gold demand. East in red, blue is the West. You can see that Shanghai Gold Exchange deliveries have been enormous. This is actually 2013. They spiked then, and they're going up. This is the first quarter demand, first quarter Shanghai Gold Exchange withdrawals. You can see this quarter is not a little bit better than 2013, not as robust as the last couple of years, but still strong. Here's a chart of China's gold accumulation. This is domestic gold production and net imports. Again, gold has been going from west to east. Here's a long-term chart of gold. January 1980, $850, 1895 in September of 2011. Looks like we really went a long way. If you look at that in real terms, you see that to equal that in inflation-adjusted dollars, we'll have to get up to $1,988. Actually, that's not right. $2,600 is where we would have to get to equal that rise. I'm running out of time, so I just want to give you these last two charts that put that in another way. Instead of deflating by the CPI, the hours of work needed to buy an ounce of gold. It's really an analog for those, or a mirror image of those other charts. 1980, 2011, this is how far we have. The gold price to equal where we were in 2011 would essentially have to double. And silver, again, silver outperforms gold, leverages gold on the upside and the downside. But this shows you that the situation on hours worked is even more dramatic for silver. Silver would have to more than triple in price just to reach the same levels of 2011. So I kind of ran through this. I did run through this very quickly, but this concludes my presentation. But the point I want to make is that we still have a lot of room to go in this market. This reminds me of 2002. The gold price had risen 30%. The mining indices had more than doubled, and we all thought that this was it, that all the easy gains were gone. But over the next 9 years, the gold price quadrupled, and as we all know, most of us in this room know, the junior stocks, the really highly leveraged plays, went over, some of them 4 or 5 times in price, and then you could reinvest those in other ones that went up 4 or 5 times in price. So there was a lot of money to be made, and that's the situation that's facing us right now. Thank you.